All right, guys, happy Thanksgiving. Welcome to another Wednesday Night Live, The Educated Homebuyer. This is where Josh and I answer your mortgage and real estate questions to help you become educated homebuyers. So you'll notice Josh isn't here at the moment. He had to restart his computer. So once that's restarted, he'll be in here helping me answer some questions. While we're waiting on Josh to arrive, I started by saying happy Thanksgiving. Hope you guys are having a little holiday tomorrow, some time with family, time with friends. It's a time to be grateful. I am grateful for you guys for showing up here every week, asking questions so that we can answer them and keep this thing moving along. So I'm grateful for you. And with that, happy Thanksgiving. If you're just coming in now, Josh will be here in a minute. He is restarting his computer. But while you're watching, while we're waiting for Josh to come in, let me know where you're watching from. There he is. Josh, your mic.
I love the shining lights.
There he is. Josh finally showed up. So Josh is here. As I was saying, though, let us know where you're watching from tonight. Start putting your questions in. We are going to go over some charts as we always do, just to kind of keep some, some normalcy with the night show. But happy to take the conversation any direction you guys want. But let's start by looking at some charts. Josh, here we are. So
apparently only Southerners pay attention to us. We got Lakeland, Florida, Georgia, and then Atlanta, also Georgia. So apparently only Florida and Georgia. The Florida, Georgia folks love us. Other than that, no one wants to listen.
That's fair. I mean, that's fair. It's, we're not for everyone, Josh, just for Southerners.
Just for Southerners.
This week, inventory actually fell by 0.5%, now sitting at 719,000 homes nationwide, 27% more homes on the market this year than last year. Weekly inventory dropped from 722,032, so 722,000 down to 719, as I just mentioned. The peak this year was at 739,000, so we are going to likely continue to trend lower, sideways lower. Probably going to continue to see it escalate here as we get closer to the end of the year. But this is active inventory looking back into October from calculated risk. Like to show this just, again, showing 2019 levels versus where we are today and where those numbers are. But year over year, active inventory is increased in most markets out there. For the majority of markets, there are still some on here. New Jersey, down less than 2%. New York down, under 7%. And in fact, we had somebody asking about New Jersey a couple weeks ago. If these numbers are accurate, you're probably still seeing a competitive market like we had discussed back then. Orange County. So Orange County and Huntington, where we finally started to see a noticeable drop in that inventory. You can see it there on the charts, how it's definitely falling off, down nearly 7% week over week in Orange County, sitting at 3,147 homes. Huntington Beach down almost 13%, down to 210 homes on the market. And my guess is that those will continue to trend lower through the rest of the year. New listings, 53,000 new unsold listings this week. We also had another 7,800 that were immediate sells. That's about 5% more sellers in total than last year. And basically looking for these levels to hold as we go into 2025 with new listings coming to the market. And then same chart, but new listings looking at 2019 and over the last couple of years here. If you want to check them out, check them out. But you can kind of see where we were compared to the last couple of years when it comes to new listings coming on the market. But most markets are still year over year. You've seen that increase, but compared to 2019, again, New Jersey, New York, Boston, that whole Northeast area, still quite a bit lower than Virginia, down nearly 51% from 2019. So there are still markets out there where inventory continues to be a problem. I saw this chart, Josh, thought it was interesting. Not a great chart for the show just because of the way it shows on here, but months of supply. I guess the definition of a buyer-seller's market is somewhere around 6 months of supply. When you kind of look back at what people have used in the past, you can see some of these areas now. Miami, 7.7 months of supply. going down to Santa Clara at the bottom. Just I can't even see that. What does it say?
1.3.
1.3 months of supply. So, but what I will say is, don't give the months of supply a lot of credit. I think you just kind of you got to feel the market out, right? I mean, here where we are, we're about 3.5 months of supply, but I think it's a more balanced market than it is anything else. So I don't think it's a full-on seller's market when historically speaking, 3.5 months would be a strong seller's market. So just follow the data.
Well, you're not wrong, Jeb, but one jumps out at me. San Diego 2.4. We have a listener who has been pre-approved for going on 6-7 months right now, and they're in that market, and they're particular. They're on the lower end of the price range for single family homes, and they're very particular in what they want and where they want to be. But every time we found a property, they found one last weekend, put in an offer on Monday. There were 6 or 7 offers, so it's not COVID era 30-40 offers, but they got beat out by an all cash offer. If you're in one of these areas that's on the low end, you're going to be in a competitive situation. You got to do everything you can to strengthen your offers. And the other point that I would make with that, it would be interesting to break down by market segments, because almost everywhere, not everywhere, but most everywhere on the entry level stuff, it's tight. The stuff that we're seeing is the higher priced homes is having a little bit harder time moving.
Yeah, and we actually have another listener of the show who I referred to sell his property down to an agent in San Diego, and unfortunately that property's sitting, but it's a unique property. It's a studio, it's smaller square footage. There's now several of them in the building listed active for sale. So it all depends on not only location and price point, but also the type of property that you're selling. Because when you have those unique situations, sometimes they can sit a little bit longer than other properties. Especially in a slowing market like we're in at the moment. So median price of new contracts sitting at 385,000, 5% above last year. The median list price is 1% above last year, and the median price of the new listings coming to the market is averaging about 3% higher than last year. So we got the Fannie Mae numbers, or was it Fannie Mae, Freddie Mac, the price index? Did you put those in there, Josh?
You know what? It's probably the most important news of the week, mortgage wise, and I failed to get that in there. But I can pull it up. It's 8065, but we'll get the high balance. And the FHA, as you know, is going to vary from county to county.
Here we are looking at percent of properties with price reductions. We're now back up to 39.1% of the homes on the market having some sort of price reductions, which you can kind of see is flattened over the last couple of weeks. So not really going down, not really going up, just kind of maintaining, moving sideways when it comes to price reduction. So new home sales, Josh, what's happening in the new home sales market? We came in way less than expected.
Jeb, it's terrible. They can't sell them. They cannot give them away. The world is coming to an end. They've just fallen off a cliff. You see that number. They were much, much lower than expected. But the important piece to look at here, if you take away the South, which the majority of new home sales in the U.S. are in the South, so Florida, Georgia, North Carolina, where our listeners or viewers are watching from today, but that is responsible for the majority of the sales, but they were the areas that were impacted by the hurricanes. So month over month, if you take that out, the rest of the country was up 8%. So generally, you want to be careful of saying, oh, we're just going to ignore that data. But it was a pretty obvious and clear reason. So as we get through another month or so, it'll give us an indication of where we're at. They also pointed to inventory being way up. But if you look here by stage of construction, 265 of those, 265,000 of them are under construction. 103,000 haven't even been started. So only 113,000 new homes completed, ready for sale. So not good data. Certainly something to keep an eye on. But the doom and gloom headlines that we saw this week were a little bit ridiculous when there's a pretty obvious and clear reason.
So going back to that chart, Josh, this one here. Yeah, so it came in at, I think, 610,000. The expectation was what, 750, somewhere in that ballpark. So, yeah. So anyhow, yeah, it's all relative, guys. You got to pay attention to the details, the context.
And there's reasons why you use a 3-month moving average, a 6-month moving average, and the reason why these things get seasonally adjusted. Not that that impacts a situation like a hurricane, but
go back one. Here we go. PCE. Right there.
So we got the PCE data today, and 2.3, basically right on with expectations. It wasn't expected to improve. We had a decent month from last year falling off, and middle of the road number. Both of those, the headline was just under, it was like a 0.23 rounded to 0.2, and the core was a 0.273 month over month rounded up to 0.3. So they both came in right where they were expected to. And as we've talked about, we need to get another month or two down the line. I think it's February when the January data starts coming out, that we have some of those hot months expected to fall off and moderate. So what I wanted to throw this in here, this is from Yahoo Finance. The headline says inflation sticking above Fed's 2% target. Well, it is, but I mean, it's pretty obvious to anyone looking at that chart that we're definitely trending in the right direction. The 3-month percentage change definitely over the last 3 months has popped back up, but you see there's a lot of noise in the 3-month. So if we look at a trend line there, we're continuing to move in the right direction. The first quarter of next year, first half of next year is going to be very, very telling. Again, if you take shelter out of the equation, we are at 2% on the year over year figures. You can't just take shelter out. But the reason why we say that is the embedded number in PCE is showing 5% year over year shelter inflation, and the actual boots on the ground numbers that we're seeing coming out are about 2%. So there's big lag between where the data in PCE and CPI is and where the actual numbers are. And fully expect that at some point that will catch up, and we're likely to have the first quarter of the year, the big numbers from last year fall off. I didn't throw the slide in here because it was largely text-based, but one of the reports that I follow, it was one of the manufacturing indexes came out today, and literally all inflation is in services. Shelter, housing is considered a service. It's not a good necessarily unless you're going to buy your house, but all actually, I want to say it was somewhere in the Midwest, Northeast, and it was goods were down 1% month over month in terms of prices. So when you look at that, we are seeing disinflation, moderation in prices. It's just taking a while to catch up. So the two big things, Jeb, that we've been looking at are jobs and inflation. So inflation is moderating more slowly than most people would like, but the Fed in all of their speeches, we got their minutes from the last monthly Fed meeting yesterday, basically saying they know what's coming, and they do expect that it will continue to moderate, but they're also pretty much looking forward to the spring and seeing what happens. In terms of jobs, we got this. To me, we talk here every week how you're getting mixed messages. We're getting mixed messages. One piece of data says the economy is softening. One piece of data says the economy is hot. So this is initial jobless claims. Weekly number of people filing for unemployment, their first initial claim. And we're down to some of the lowest levels that we've seen here. And you can see clearly that trend is also down. So you look at that and you say, it's a really tight labor market. No one's having to file for unemployment. But then we look at the continuing claims. These are the people who filed for unemployment and then are out theoretically looking for a job. And we see these numbers just continuing to trend up and up. So employees are not leaving jobs. Employers are not letting employees go. But on a month over month basis, those that are losing their jobs are having a harder and harder time finding a job. So kind of a tale of two markets, two situations there. Week over week, Jeb, last week, we were basically at 50-50 odds. It was what, 55-45 of a cut. Next month, we're up to 2-to-1 odds again. What I wanted to show, this is that long-term trend, that downtrend red line. We never got all the way up to that 450. So we had peaked above that, but now we're looking at about a week here where we were under that line. Now, always important when rates were going in our favor. Last holiday season, we wanted to point out to everyone, the last 5-6 weeks of the year, trading gets really light. You can't put too much stock in what's happening, especially when we're looking forward to the first quarter for data. So this absolutely could be a head fake, but we wanted to see that red downtrend line hold, and so far it has held. This is another look at that, and this is a Heikin-Ashi candle, Jeb, versus a regular candlestick. It kind of smooths some of it out, and it makes trends a little bit more obvious. You don't have as much of the bouncing around. So you can see on the left side, we were in that nice downtrend. It gave way to a pretty long, steady uptrend of 2 to 3 months, and it looks like hopefully we are seeing the start of an initial downtrend. What does that mean for interest rates? Well, you can see all these green arrows. downwards in the terms of day over day, week over week, still up a little bit over the last month, but we're a little bit below where rates peaked. So assuming that we've seen the worst of it, hoping that we've seen the worst of it, and rates continue to trend a little bit better.
All right. With that said, I know there's people out there looking to refinance still, waiting for rates to come down. If you'd like our team here to monitor that for you, you can head over to jebsmith.net/rate watch, and that will get you to us so that we can actually watch it on your behalf and alert you as rates move downward. That way you don't have to follow it every single day. And then here is a map of the United States. If you weren't aware, that entire area of the United States, we can help you in. So if you're looking to buy, sell, refinance, reach out. Our team here would love the opportunity to assist you, help guide you, and get you to the finish line. Josh, what are we doing now? Do we even have any questions? Are we doing anything tonight here?
There's two questions. The Thanksgiving crowd is a little thin and light on questions, but one of our most frequent questioners, SNN Media, says, why does FHA keep raising the loan limits? I think it's now above 800,000 starting in 2025. Isn't this contributing to the continuous rise of home prices and reduced affordability? So it's the FHFA that makes the decision for the Fannie Mae Freddie Mac conforming loan limits for the coming year. And it's actually in their guidelines. They are reacting to the data. So they have their analysis. It's from the quarterly year. It's the year over year appreciation quarterly measured at the end of Q3. So we just got that data yesterday, and we have new loan limits of 806.5 for the next year. It is indexed to home prices going up, just like Social Security is indexed to inflation. When things get more expensive, you get more money. When homes get more expensive, you have a little bit more power. If you look at this, it would be interesting to track median prices in some areas relative because they're not consistent. So if you look, they track unevenly. So some areas, like for us in Southern California, this 806.5, there's large parts of the Inland Empire where, because they don't have high balance loans. So for a lot of the country, you don't have access to high balance loans. For San Diego, LA, Orange County, the Bay Area, Ventura County, they have up to 150% of the standard conforming loan limit. So that's $1,209,750. You can get a Fannie Freddie loan. But a lot of the parts of the country, for us in Southern California, those that get priced out of LA and Orange County, a lot of people look to Riverside or San Bernardino, just a little bit inland, and they don't benefit from that. So if you're looking at a nicer home in the $900,000 $1 million range in, say, Rancho Cucamonga, where homes can easily go to 1.1, 1.2, you're going there for affordability and a little bit bigger, nicer, newer home, and you're still getting forced to a jumbo loan. So I don't know, Jeb, what are your thoughts on that? Do you think they should just stick the loans at 417 like it's still 2017 and never let them grow any bigger?
No, they should definitely grow. But to answer the question, does it hurt I mean, does it contribute to the affordability problem? Yeah, sure it does. I mean, it allows people to qualify for more mortgage and buy more expensive homes. If the mortgages were stuck, that would be a problem because less people would be able to afford them. They would come down in price. So yes, I understand the question, but the reality is, I mean, in order to help people become homeowners, it's a necessity, especially in markets like California and, where prices are just, out of this world for most people to fully even comprehend what it is. Like when I tell people prices here, it just like mind blown, when I post something on Instagram and like telling people the price, they're like, are you serious? I'm like, yeah, that's what it is. It's nuts. Anyhow, another question here, Josh, coming in, asking about new construction. Just says, how does new construction affect existing inventory price wise? It depends. I would say that new construction prices affect existing in probably pulling them up along with new construction prices. So, but what I will say is, it depends on some areas, right? Most of the time, new construction is going to sell for more than existing construction, typically speaking. If you take the same square footage, same bedroom, bathroom count, that sort of thing. But there is location is definitely something that has to be factored in when talking about when talking about prices. And so a lot of times new construction is built. We talk about this all the time, further out, further away from the epicenter, further away from, shopping, dining, all of these things. Maybe over time it gets developed, but that can drive up prices of existing homes that are in better locations, in areas where people want to be, that sort of thing. And also existing typically has bigger lot sizes. You don't have the tall, skinny, tri-level type of building. It's usually more of a ranch style or two-story homes on a larger lot. Most of the new construction, at least in California, is not that. So I would think most people still lean towards existing construction if they can find the right home versus new. Most people don't care about it being new. They just want the right property. But there are people that do want just new. Mina coming in with her weekly $5 super chat. So thank you, Mina, for doing that.
She doesn't want to thank you. She wants an answer to an important question and
Turkey
an
all day.
unhappy question.
Turkey or ham is the question. Turkey or ham? That was the question, dude.
That's not her important question. She has a far more important question. She's only been in her home for 3 months. Now she's receiving a letter from the lender that there is a shortage of $4,400 in her escrow account, which they now want to spread out over 12 months. That's almost $400 a month. Mm-hmm. Mina, correct us. You're here in California, right? So my mind is kind of blown that you could be that far off in the state of California. It's fairly easy in California to look up what the property taxes are going to be. And that's the biggest element of your escrow impound account. Your homeowner's insurance, I'm thinking in the first 3 months, you probably didn't change it. So that shouldn't have changed.
Is it new construction?
On you. Even if it's new construction, there's no lender in the world that is going to use the taxes on an empty lot, which is what it's assessed at currently, versus giving you the real number, unless they're completely incompetent, in which case I would take it up with them. Mina, you have used the info at the Educated
She's in Maryland.
Homebuyer. Okay, in Maryland. So, okay, it's more complex. Like I said, California is one of the easiest ones. They all should be almost impossible to miss this badly. But use the email, the info at theeducatedhomebuyer.com. Send us an email. I'm going to ask you to send over a couple of documents. I want to see what your closing disclosure said and what they were collecting for impounds. Look at it, what it should have been, and possibly that letter that they sent you stating how it's off. I'm puzzled as to why 90 days in, they're doing a reconciliation. Every 12 months, your lender is required to look at your impound account and make sure that they're not short, that they don't have too little in there, and also to make sure that they haven't collected too much of your money, because the law says they can't have too much of your money in there. And sometimes, believe it or not, they do have to refund some of your balance. But that's just bizarre that it would happen in the first 90 days and it would be that far off unless the lender that closed that loan made a really big mistake.
Yeah, it just doesn't seem right. Yeah, send that over, Mina. We'd be happy to take a look at it and give you a more detailed answer. Sharky says, I heard if your home value goes up, your monthly payments will change and go up. Any idea? So false, unless it's taxes or something changing that's affected, your value, the homes around you value going up, which might affect your tax basis over time. That could affect your monthly payment because of the impounds, and that could make your overall payment go up. But if your mortgage is fixed, regardless of what happens to your home value, your mortgage payment itself isn't going to change. Your principal and interest payment is going to stay the same regardless of what happens to your home value. Now, the other things are variable, a little bit. Taxes, insurance, those things can change over time, which in turn can affect the payment, but it shouldn't be substantial in most cases. Now, in some of these areas where weather prone, hurricanes, natural disasters, flooding, a lot of that stuff right now, fires, that can affect insurance, and insurance costs can drive that up, but that's a little bit different than your home value. So the home value shouldn't really do much to your monthly payment. Turkey or ham, Josh? Mina asked that question as well. You didn't answer.
I'm not a huge turkey fan. I don't hate it. It's just kind of, I can take it or leave it. A ham I enjoy.
There you go. So you're a ham fan. So it would just be ham. That's all
I had to give the explanation.
No, you just say I'm a ham guy. No, I'm a ham.
I'm not a ham guy. It's not top of the list. Neither of those are really, give me, I don't know, some other stuff. Give me some prime rib. Give me if we're having sandwiches, I'll have a tuna fish over the ham or the turkey. We got lots of other options.
All right. Anu says, is there any real advantage of being within conforming loan limits? From what I have seen, jumbo loans typically have an 8 to a quarter point lower interest rate. Josh, is that correct?
It generally does. And during COVID, we saw jumbo loans a 0.5 to 0.75% better in interest rate. So lower interest rate makes it better, right? Yes, except generally larger down payment requirements, tighter debt to income ratio restrictions, reserve requirements, and higher credit score requirements. So if you have a 680 credit score and you're trying to get a 10% down jumbo loan, good luck. Those terms are going to be much, much higher than a 10% down 680 conventional or FHA. So there's more to it than just, hey, jumbo loans are better because they have a lower interest rate. All other things being equal, an 800 credit score borrower putting 30% down and going to qualify either way and going to get the best terms. Yeah, you probably would rather go to a jumbo loan because you're going to get slightly better terms, but that's assuming that you cleared the bar of being able to qualify for the loan.
All right, we have a comment and then more of a comment, but we're going to make it a question. Josh, it says interest rates aren't the end all be all for affordability. I don't get how this is sustainable as we're in unprecedented times where local income does not match home prices. It's coming from a frustrated Texas home buyer. So, Josh, there's three variables that affect affordability. We talk about them all the time: home prices, wages, and interest rates. Interest rates are the one that can change the paradigm the most and the quickest, if you will, in affordability. Wage growth has been pretty consistent, somewhere around 3%, 4% over the last couple of years. Home prices have been crazy over the last couple of years, but more moderated now. Interest rates are the one thing that can change it. But I want to address the question of incomes to home prices. Do the two follow? What's the metric there, Josh? Where are we getting this wrong?
It's not that we're getting it wrong. It's the what dictates prices. So prices versus affordability. Is he correct that prices as represented household income, a larger percentage of median household income going to buy the median priced home than we've seen historically? That is absolutely correct. Not wrong at all. DV's got that dead on. But what dictates prices? Prices is supply and demand. So we go through the charts every week. You've shown demand is down. We have less people who are willing and able to qualify and buy a home today. But because so many people bought at so much lower prices with so much lower interest rates, they're not selling those homes. Builders are not building at a fast enough rate that there's enough supply for all of the people that want to buy. So what we have seen is over the long haul, homes get less and less affordable. And that's like a 50, 60-year trend. So we're at the extreme end of that. But what we've talked about, there are plenty of channels, if you want to go watch crash porn, that will have been telling you for the last 7 years that a crash is right around the corner, and yet we have not seen it because of those supply-demand dynamics. There are two things that can happen, many things that can happen. But what is most likely, again, we talk about Bill McBride did a great breakdown at calculated risk, 7 years in purgatory and 7 years, something like that. I forget what he called it. I'll find it. I'll throw it in the links. But basically saying that we should expect a protracted period of below trend home price appreciation because we had a protracted period of way above trend home price appreciation. And during that time, interest rates should moderate. Don't know that they're going back to 3%, but I don't think 7% is the norm. And you get 5, 6, 7 years of 3 to 4% wage growth, and you have aggregate increase in wages of 30 to 40%. And now home prices are affordable if they haven't gone up significantly in real terms over that 3, 4, 5, 6 year time frame. So not wrong, definitely perceiving those things correctly. But Jeb, what you said is the most important thing. Of those three things, we're not going to see a 25% spike in wages in a year. You may want it to be, but we're not going to see a 25% drop in home prices. The only thing that could move 25% in the course of a year is interest rates and the equivalent payments on those houses. There are people now stating that's never going to happen. That period of ultra low interest rates is done and over with and not coming back. And they may be right. I don't think they are. And the next couple of years are going to tell us that. Do we normalize in that 4 to 5% range and home prices get somewhat more affordable? We're going to see. Only time will tell.
All right. Willing came in and asked a question earlier in the show. I just saw it now. Asking about athletes and mortgages, Josh. Is there any difference in athletes, stars, actor, anybody that how they obtain mortgages?
Absolutely. So look at
Did you
it
hear me?
and say, from this perspective, what an underwriter is looking at, almost all of the guidelines say we need 3-year continuance of income. So let's say that your favorite star athlete has 2 years left on their contract. We don't know what happens after that. So a lot of these get pushed into private banking relationships. Hopefully, these people have really good credit. They have millions of dollars sitting in the bank. Where this gets really difficult is not your star. I got the Clippers up over here. It's not James Harden who makes $40 million a year and has $100 million in the bank. It's the guy that's the eighth or the ninth man. He makes $2.5 million a year. After he pays everyone and pays his taxes, he's got $1 or $2 million, and he's on a 1 or 2 year contract. So he doesn't have that same financial strength, and he doesn't have a massive investment house saying, yeah, we'll loan you based off of your investment portfolio. So most of that, you end up in private banking relationships, non-QM loans, where it's based off of decent credit, big down payments, large assets, because most in the current age, other than hockey players, we don't have these super long-term contracts. Hockey players and baseball players are more likely to have those long-term contracts. But if you don't have 3-year continuance on the contract, you're going to have to be looking at some type of alternative documentation or alternative investment relationship with a lender.
Yeah, and most of these guys, these small community banks and whatever, there's relationship. It's all relationship. Like they want that money there. They're willing to do things outside the box to get these people into homes and do different things. It's kind of like the what's the one bank, the Silicon Valley Bank, the one that went belly up. They had a lot of these people, mortgages and that sort of thing because they do things that the bigger banks and stuff don't do. So anyhow, Josh nailed it there. But Josh, we got some questions here on one on second homes, just asking why a second home down payment is higher versus a conventional loan. Essentially comes
So
down
they
to risk,
they
right?
didn't used to be. So as part of our social justice FHFA, changing the loan level price adjustments, they said, hey, we're subsidizing people buying second homes. And if you do have a government subsidy through the implied guarantee, maybe that is an area where it's a rightful question to ask. Should we be making it better or easier for people to buy a second home at the expense? It's not really at the expense. No one was limiting people buying their first home. So that's sort of where I don't agree with this. But we've always had it up until about 2 years ago that you had to put 10% down on a second home versus 3 to 5% on your first home, but you were going to get the same terms based off of your qualifications. Now it's priced the same as an investment property. Some of that could be implied risk. Why do we say investment properties have a higher interest rate than your primary home? Because if you hit hard times, you're probably going to let your investment property go before your primary residence. The same would be true for a second home. So there probably is some level of risk there. But largely it's because the FHFA said, hey, we can do these loans, make a little more money, and then subsidize other folks with lower credit scores, lower down payments getting into the market. So again, this is an area where we have a new administration, we have a new HUD secretary. We'll probably get new leadership at FHFA and the CFPB, and we'll see what happens with that. I don't necessarily think we'll ever go back to the olden days where you put 10% down and can buy a second home with the same rate as your primary home. But I think there's a balance there. I think we've gone a little bit overboard with how expensive it is for folks buying home. Is it reasonable for them to pay a premium? Yeah, I think it's reasonable for them to pay a premium. Not as big of a premium as we're charging right now.
All right. SF Minor says not a question, but thank you guys for doing this. So thank you for being here at the start of the show. I just said thanks. Happy Thanksgiving to everyone. We're grateful that you guys show up every week, ask questions, allow us to do what we do, and also grateful for all of you who reach out and actually use us and allow us to help you. We're grateful for that. It's the support has been awesome. So thank you.
So, Jeb,
Yeah,
we've got another comment here, and I hope it's true, and I hope he's not being facetious, because this would be possibly the greatest compliment, even though it would never result in any business to either one of us. Hi, my name is Tim. Says, "What's up, boys? All these years watching you, I've been saving and living like a dog. So forget a mortgage. I'm going all cash and have my first home at age 43 with no mortgage." If you've saved up and you are out buying your first home all cash, that's a beautiful thing. I mean, really,
yeah,
we
for
talk
sure.
about get into a home, fix your housing cost, except for your taxes and insurance, and work on paying it off, so that you can arrive at a freedom point in retirement where you don't have that mortgage over your head. You kind of turned it backwards on us, but I don't know, Jeb. I'm glad we were able to be a part of that.
No, that's awesome, dude. I mean, congrats. I hope that's an accurate statement. So, congratulations to you. Now work on the second one. I think that's the next goal, right? Jamie has a really good question here. It says, for folks who have RSUs, equity as part of total compensation from an employer, do RSUs count towards income when qualifying for a mortgage? So it's basically restrictive stock is what it is. For anybody that's not familiar with the acronym RSU, it's restrictive stock. So sometimes it can be part of your compensation. And then you typically have to keep it a certain number of years before you can cash out. So Josh, how does an employer look at that?
The biggest issue from an underwriter's perspective, if you just started getting RSUs 6 weeks ago, you're in a situation where you're getting them and you're going to get taxed on them. They're going to show up on your W-2, but there's a vesting schedule, generally 3, 4, 5 years before you're fully vested and can access those funds. And so the employer is saying, hey, we're giving you these additional funds, but we need you to hold them so that it doesn't impact our share price. And we need it to kind of tie you to us as a company so that you'll be here contributing to that growth over the coming years. So probably the best example, I have a client who is a Costco store manager. Those guys make good money. I mean, the top boss in a Costco store, and he started, low end as an 18-year-old, worked his way all the way up to the top, and they get a nice salary, but it's like 60% of their income is in RSUs. And for the first 4 years on his 4-year vesting schedule, he was having it given to him and going into his account. He was getting taxed as though he was making that money, but he didn't have access to it to make his mortgage payment. So as long as you're fully vested in your RSUs and we can show that vesting schedule, show that you have access to those funds and you can use it for making the monthly payment, whether you're going to or not is totally up to you, but you have to actually have it liquid where you can use it.
Good stuff. Actually, one of my buddies is like the regional. He's like the guy above the store manager, Southern California, Mexico. Like I follow his life on Instagram, and I'm like, damn, that guy lives a good life, man.
Well, my guy, I did their first purchase for him when they were like 23. I was there with him when they moved to Texas. He had to go to Texas to get a store. If you're in that system, so he didn't go to college. He had legit started at 18, worked his way up from the very front end. I think they make you literally start in the food court if you get a job there, and worked his way all the way up to the top, and went to Texas and got his own store. And now their kids are off in college. They own multiple properties. It was a cool thing to watch.
You ever had the warm chocolate chip cookies from Costco?
They don't make warm chocolate chip cookies at Costco, bro.
Oh, they do in the food
Who
court,
makes
buddy.
these?
Costco does. They
just hand them to you.
Last time I was there, they were serving to people in a pizza box. There's like, I don't know how many of them.
I don't think this is Costco. I don't know where you're going, but you're going to some strange place. You guys reply in the comments if you've ever seen chocolate chip cookies in pizza boxes at Costco.
I don't know if they serve them all in pizza boxes. This person got a lot of them and they were in a pizza box. Yes, they do. But if you haven't had it, you should try it. Delicious. Coming right out of the oven there, Josh. All right, let's go. There was another question here. Juan says, when a new listing comes in Zillow or Redfin and the host has more than 100 days listed, why is it that the listing agent takes it out and puts it back on the market as a new listing? So it doesn't matter if they do that or not. There's something called days on the market and cumulative days on market. So if you take a home off the market today, if it hasn't been off the market for at least 90 days, at least in the way the MLS works here in California, then it still shows as the same. The cumulative days are still whatever. So if there's 100 days on the market, you cancel it and come up with a new listing tomorrow. If it hasn't been off the market for 90 days, it just shows one is days on market, but 101 cumulative days. So you know that home has been on the market for an extended period of time. The caveat is if you pull that home off the market for 90 days and relist it at that point, it will start over. The days on the market will start over. So sometimes agents do that to reset a property. If something has changed in the property, they've changed the price, they've remodeled it, they've done something different. oftentimes it's a good reset to come back on the market as a quote unquote fresh listing. But in order to do that, you have to have that 90-day window. All right. So hopefully that was helpful.
Tim says you have some sort of special fancy Costco that you go
Dude,
to.
I'm telling you,
The
I'll
New
take a
York City
picture.
Costco has pizza.
I'm actually
and hot
hungry now.
dogs.
I'm like thinking about these things. So I might actually go to Costco and get these.
Okay.
Not doing it tonight because it's crazy.
Because there's
Thanksgiving.
9 million people getting their pumpkin pies.
Yes, exactly why. But we will do this. We will do this.
Importantly, if you are local to Southern California and you have done business with Jeb, in perpetuity, you will not have to go and go to Costco and get your own pumpkin pie. You can come hang out with us at Jeb's lovely annual Halloween, Thanksgiving holiday pie party, and we'll drink some beers and we'll enjoy the evening. Thanks
so
Mr.
every
Jeb.
Thanksgiving, the Tuesday before Thanksgiving, I invite all my clients, present, past, people that I did business with 10, 20 years ago. There's a lot of people on this list. And last night, I don't know, total, I think there was something like 50 something people RSVP'd, individuals. So with couples and kids and all of that stuff, there's probably 120, 30 people came through that thing. But I give out pies to my clients and food and drinks, and it's a merry evening. So it typically goes from 4 to 7. I don't think we got out of there last night, Josh, until like 9:30 because people hang out and have fun. So it's good. So all you got to do to get that is just become a client. It's really easy, guys, and you get it for life. So
for life, you never have to go to Costco and fight the crowd Wednesday before Thanksgiving and fight for the last.
Yeah, see here, Maddie coming in. Costco food court has awesome chocolate chip cookies, very large, but not pizza. Here's the thing:
says you're lying. You said you're lying about them being pizza size.
I saw a guy. No, they're not pizza size. I saw a guy get an entire box of them out of the oven, and they served it to him in a damn pizza box because there was like 20 cookies in this thing, and I was like, that. And so I went over and got a chocolate chip cookie. And so that's how I know they have them.
So adjacent, but slightly off topic. Have any of you guys had the cinnamon rolls at Costco? They only do them like certain little windows of the year, but it is a big, fresh baked. Oh, oof. They're amazing. But every time I go, it's like they've trained me to look for them, but only like twice a year do they ever have them.
This is becoming a Costco show. I need to tell my
Costco
buddy,
is a great thing. A great thing.
You know, that we need some sort of sponsorship. Let's see. We've got Lehigh says, hello, first time viewer live. Your videos have been helping me almost closing day on my first home in Northern California. So thank you for being a part of the show, coming in here, dropping that and listening and using us as a resource. So we appreciate it. There's a lot of smart people out there. There's a lot of people that give a lot of valuable information. You have a lot of options to go to. So we appreciate you choosing us and using us as a resource. So makes the time well spent.
Jeb, because I've had a couple of friends and clients ask this, and I don't know the answer, I want you to answer, and hopefully you have it. Jamie's back with another question. If we recently bought a home, is there a way to take down the photos of the inside of the house from Zillow, Redfin, etc.? There seems they're pulling from the MLS, and I don't have access. It's funny. I've never thought of it, but there are people out there for privacy reasons don't want people to know what the house looked like before they bought it.
Unfortunately, it has to be done prior to the house closing. So for example, like if you don't want photos, got to tell your agent prior to the home closing that you don't want them on the MLS. The problem is websites like Redfin and Zillow and some of these things basically store some of that data. And so you can go back and see photos from when they were previously posted. You might be able to, as an owner, say that you're the owner of the property and have those photos removed on Zillow and or Redfin. I'm not sure how Redfin works. Zillow, I know you can claim a listing as your own and might be able to have them removed, but I don't think you'll be able to get them off all the websites. But it's one of those things that it does get requested. But typically what happens is I'm the listing agent on a property and the buyer has another agent, it closes, and then the buyers somehow reach out to me after the fact to say, hey, you had this property for sale. I bought it. Can you remove the pictures? And it's like, no, unfortunately, I can't do anything. I've tried to contact the MLS several times and they won't do it. Now, as a buyer, you might be able to contact the local MLS and have them do it. But I think some of these sites are still going to syndicate the stuff, unfortunately. So might be stuck for now. Josh, we've got a question here on HOAs. Have you seen loans denied due to bad HOAs, budgets, or too many defaults from owners? Absolutely. It's not common, at least here in California, but it does happen. I've seen them more so on budgets, not having the right financials, more so than anything else. Defaults from owners, I haven't really had a problem. I have had issues in the past, Josh, when I did loans, too many investment properties in a neighborhood. You can only have a certain percentage of non-owner occupants in a community in order for lenders to finance loans. So I've had that, but yes, it does happen, but it's not as common as you might think.
You hit two of the big three. One, just being underfunded for maintenance of the complex. They're going to look at the budget. They're going to look at reserves. All of those things are going to get reviewed. So if they're underfunded, that's going to be a problem. If you have excess non-owner occupancy, it's going to be a problem. And the last one, and the bigger one over the last years, especially in Florida, is insurance. Insurance has got really expensive, especially for older complexes that don't meet current guidelines, that are in high-risk areas, whether it's wind, tornado, flood, fire, any and all of that. So yeah, there are some pretty significant requirements. And from a lender's perspective, I would say that's probably their number one pain in the ass issue right now, is making sure that they've checked all of the boxes, and Fannie, Freddie, FHA, VA, whoever is insuring the loan is going to be okay with it.
All right. Easy question here. Can you buy down mortgage rate points anytime, or is there a certain time? You have to do it before you close on your loan. You can't do it after your loan is closed. So before your loan closes, you can do it. It can be locked, and you can change it and still buy down the rate at that point. But it has to be done before your loan closes, not after the fact. This question, a question similar has been asked a couple times, but why do interest rates vary depending on loan product type, and why do they drop more so on one product versus another? So say a 15-year fix, why does it drop 0.1% versus one product dropping, none?
So if you're looking at a 15-year loan, think of that as a rapid amortization. So by year 10, you've got most of your money back. So it is tied more closely to shorter term treasuries, 2-year, 3-year, 5-year treasuries. Whereas that 30-year, that it goes down very slowly, it's more generally looked at to be tied to the 10-year. Over the last few years, it's closer to like a 5 to 7. But you're talking about small differences. We're talking an eighth of a difference, 0.125 difference in pricing over the course of a day. It is simply due to the investor who's making the loan, their expectation of repayment, and what yield they want off of that, based off of market yields on alternative investments in the current market.
All right. Asking a question. How does deferred comp, Josh, work like compared to RSUs? Can you use the income? Can you not? How does a lender look at it?
Think again in terms of, do I have access to it? Can I get my hands on those funds to make my monthly payment? So anything voluntary like deferred comp that you can opt out of at any time, a 401k. So maybe you max your 401k. You've got $1,500, $2,000 coming out of your pay every month. We don't care, because if you hit hard times, you don't have to do that every month. So if it's voluntary and you can get your hands on those funds, no problem. If it is involuntary and there are requirements or timelines before you can access the funds, we can't necessarily use it to qualify you.
All right. Let's see what we got here. Just going through a couple questions. Not really. You see anything, Josh?
Maddie followed up with the wrong answer. She said her favorite Costco bakery item is the walnut cranberry bread.
Oof.
Wrong on both counts. Walnuts are wrong, and cranberry doubles the wrong. Two wrongs do not make a right in this situation.
No, why would you put anything in your bread?
No,
other than
that's
cinnamon.
Terrible. It's a terrible idea. Maddie, come to the pie party next year and get a good baked good that is not something along the lines of walnut cranberry bread.
Yeah, we don't do that here. In fact, we're against that.
We just say no.
Don't ever say that again. That is against policy here. Josh, read her the rules.
we have a terms of service agreement.
That you acknowledge that you cannot put walnuts in your bread or cranberries in it. Let's see. It is 49 minutes on this evening, and not a lot of people on. Rakesh is saying that the chocolate chip cookies at Costco in Maryland are awful. Well, I don't know what to tell you, dude. They're not here. You might need to come out here. We have a friend a mutual friend. I don't even know if Josh knows this about the friend, that he has it. So Albertsons is a grocery store here in Southern California. It might be where you are, but whatever. It's like a major chain, right? That he has relationships, quote unquote, relationships with the bakery department, so that when they make fresh chocolate chip cookies, they call him and he comes in and buys bags of these things. Do you know who I'm talking about, Josh?
I do not.
Pablo.
Pa- Pablo
Pablo,
has lots of interesting quirks,
dude,
and
this guy buys chocolate chip cookies. Like they reach out to him and let him know that they're making them. So I need that connection. I'm a chocolate chip
we got to
cookie.
find out who his connect is. You know,
Anyway.
the Albertsons little bags of chocolate chip cookies are pretty good. I bet you they're even better when they're fresh.
I don't disagree to that. Anyhow, we've gone off the deep end here, guys. Let's see.
Well, they ran out of questions to ask, so we had to talk about important things like Albertsons chocolate chip cookies.
Yeah, G Money's on the show. Says, looking to buy my mother-in-law's home, but I don't want to mess with the mortgage rate. How could I go about that if possible? You could
An all-inclusive trust deed.
Yeah, you could get added to title on the property. The mortgage is going to stay in her name. Yeah, I mean, but how do you pay? You gotta.
So here there's a follow-up question that is essentially the same question. That dude Jay says, any thoughts on the risk with subject to loans? There's two ways of doing this. There's risk to you as the buyer, there's risk to the seller. So the reason why I said an all-inclusive trust deed is essentially there's a deed of trust or a mortgage securing that loan against the property. As the seller, what I would want to do is put an all-inclusive trust deed that wraps that plus any funds that you owe me for additional down payment. So you can make some down payment, they can carry it in that, but you have to make a payment to them every month and they make the payment to the underlying lender. Now there was a sale, there's going to be a transfer of title. So your mortgage, her mortgage most likely has a due on sale clause. So if the lender finds out about this, they can call the loan due and make you pay it. And there's no ways around that. Unless it's some type of assumable loan, FHA or VA, where you could assume it. But if you do an all-inclusive trust deed, that protects the seller. You as the buyer, if you roll in and say, I will take it subject to your existing loan, don't worry about it, I'll make the payments. They deed you the property. You're now the owner. They still owe the loan, and you may or may not make those payments. If you stop making those payments, they don't get to foreclose on the property like they would with an all-inclusive trust deed. The lender gets to foreclose on the property, and they're kind of out all the way around. So the risk is to the seller in the subject to. If you want to sell me your house subject to the existing financing, it's a great loan. I'm totally cool with it. I'll make the payments because I don't want to lose the property, but you don't know, some other yahoo may not. So if you're going to sell the property, make sure you're doing it with an all-inclusive trust deed. If you're going to buy it, see if you can get it with a subject to.
Yeah, and if it's your mom, I think you're good. You should be.
Hey, we've had plenty of kids screw their parents over purposely or unintentionally.
Yeah,
with the best of
So yeah, but Josh nailed it. So hopefully that's helpful. So here's a question here. I'm looking at a property zone commercial with a residence and tenants. I would have to go with a commercial loan, right? Question mark. Would having a residence on the property be an issue? Thanks. So basically what you have here, Josh, is a property that's zoned for business and residential. Can you do a residential loan on it, or does it have to be a commercial loan?
The simple answer is, as long as the residential use constitutes 51% or more of the usage, generally by square footage, not by you saying, no, I primarily use the commercial parts, you can get an FHA or a conventional loan. So just make sure you're going through the details on that specific property with your lender, your loan officer on the way in, and that they know exactly what you're dealing with and get that pre-flighted. It should be okay. The majority of these properties were built that way to meet the guidelines. If it's a 100-year-old property, who knows what they did.
All right. Slow motion for me. Slow motion for me. I'm singing it in my head. I was trying to, yeah, because I know.
I thought you were singing that new Kendrick Lamar album in your head. I thought that's what you were singing.
Are you familiar with the new Toll Brothers communities in Valencia? What do you think about that area? I'm not familiar at all. Take me out of Orange County. I know nothing when it comes to communities being built. So not a good reference for you. If you need somebody, let me know. I can refer you to somebody up in the area that knows the market way better than I do, knows that market like I know my market. Let's see. Robbie says, is it common for sellers to say a house with a lot of interest will be sold as is with no repairs or extra credits? I'm wondering if that's final or if there's room to negotiate. So it is common for somebody to say a property is being sold as is, and that they're not willing to do repairs or offer credits or anything, especially in competitive markets. Here's what I will say. I've sold a lot of properties representing buyers where people have where sellers have said it's as is, and we have moved forward with the transaction and still gotten things repaired. At the same time, there are sellers out there that like when they say as is, we're not doing anything, they will die on the sword and not do anything. They'd rather the deal fall apart. Now, typically, if they have a good agent, their agent will help negotiate that and get them through it. So it's hard to say, but I will tell you more often than not, as long as it's not a lot of money, a major issue, things that need to be addressed, whether they're selling it to you or someone else, chances are the seller's going to do it. Especially if it's not a lot of money coming out of their pocket. You got to use that leverage of being in escrow to your benefit to some degree in order to get things. But if you're going in there saying, hey, I'm willing to accept as is, and now you're coming back asking for a ton of stuff, you're probably not going to get it. Hopefully.
I had no idea the chimney was separating from the house. I couldn't see the 3-inch gap when I walked through the house.
That's a true story, by the way, guys. But fortunately, we backed out. We didn't. I recommended my client back out before we ever went to repair.
Before your client saw the 3-inch gap between the chimney and the house?
But yet he was still willing to move forward with this house. It's crazy. And fortunately for him, the seller didn't budge. I actually want to go back and see what that house sold for, because I'm interested to see if somebody was willing to pay that price, because it did go back into escrow. Yeah, mind blown. Anyway, inspectors are important people going through the home buying process. Don't skip the inspection, guys. Even in competitive markets, don't skip it. Don't skip it. If a contract says new roof to be paid by sellers, can the loan close without the new roof being done due to roof company delay? No. It could be a credit to the buyers, but if it's, Josh, correct me if I'm wrong, this is how it used to be. If it says repairs, those repairs have to be completed.
You're not wrong. Escrow holdback. There's a potential for an escrow holdback, but roofs are expensive now. Generally, an escrow holdback is $2,000, $3,000, $4,000. If you have a $15,000, $20,000 roof, lender would be rightfully afraid of that. They're also going to say, hey, the appraiser needs to comment on why are we agreeing to do this? I mean, the appraiser didn't say there's an issue with the roof. Maybe I want a roof inspection. If a roof inspector goes out and say, hey, this roof has 5 years left on it, seller's just doing it out of the goodness of their heart, maybe we can convert it to a credit. So generally, a realtor like Jeb, someone else representing you is going to call and say, hey, they're going to give us 15 grand for a new roof. Let's say it's a $500,000 purchase. That's only a 3% seller concession. I would much rather, if it's not going to be done by close, get that concession, reduce your cash to close. Now you have the money. You can get the roof done afterwards, as long as there's not anything coming up on the appraisal that says there's an issue with the roof.
All right. Josh, Kimberly saying, do you think it will be difficult to get a good loan on a first home after retirement, basically with the only income being my husband's pension and Social Security? I'll be looking for a job. So good home, all relative, but can you buy a house, Josh, with just your income coming from pension and Social Security?
Retirement doesn't change anything. It still comes down to debt to income ratio. I've literally seen people with $25,000 a month pensions. They don't have a hard time qualifying for a $400,000, $500,000, $600,000 loan. I've seen people with $400 pensions. That's a different animal. So if we have a decent sized pension, we have Social Security income, the debt to income ratio is reasonable. Generally, people buying with reduced retirement income heading into retirement have assets. They're putting a decent sized down payment. They're not wanting to buy outside of their means as they realize they're entering retirement age. So it shouldn't be a problem, but it really is just going to come back down to the debt to income ratio, which is all relative to how much you're purchasing, how much you're putting down, and what that pension looks like.
All right. Good stuff. We're going to save that comment till the end.
It's a good one.
He's pushing our buttons here with the old walnut free cranberry free. I like that. I like your comment even more now.
He's wishing you the good stuff.
That's the good stuff.
Being very kind heading into Thanksgiving.
Let's see. Do we have a couple more questions, Josh?
Well, here, let's just, it's a negative question, but we're going to go ahead and answer it, Jeb. Joey Stroud, any chance that we'll be able to get a house and not be
No.
upside down on it before I unpack?
No,
So
absolutely not.
let's look at the
buy.
reality of
Never
this.
buy.
How many people in the last 5 years bought and then we're upside down? If you look, we're going to be doing projections. You and I were looking at a chart, an aggregate of all of the major projections out, and the lowest was 2% appreciation over the course of the next year. So I'm assuming you're going to put a down payment in the next year, should go up 2 to 5%, according to most economists. So from that perspective, when you say Louisiana is struggling, most people are expecting Louisiana values to probably drop over the next 12 months. Not a lot. Properly and probably. If you're in Southwest Florida and hurricane zone that has a lot of damaged properties, maybe there's an issue. If you are buying in 89% of the United States and you're putting a down payment, there is absolutely no reason to expect that you would be upside down in the next 12 months. I think that's Reventure Consulting's mom.
There you go. Perfect. Let's see. Willing, is Zillow accurate for value? No, it is not. It's a tool in the toolbox. Use it, but don't rely on it. It's one of those things that, depending on where you're located in the country and what has sold around you and how your property compares to it, it can be very accurate or it can be completely inaccurate. Understand it's just an algorithm going out and trying to find comparable properties, but it doesn't know location, it doesn't know upgrades, it doesn't know the ins and outs. It just knows square footage, bedroom, bathroom count, and that's how it makes some of these assumptions. Doesn't know if it's attached versus detached. All of these things that affect value. Doesn't know if it has a view, doesn't have a view, doesn't know if it has street noise, not have street. All of those things matter in the value. So just use it as a tool, but contact a real estate professional and let them be the one to guide you through the process. That said, we've been on 1 hour and 1 minute. Thank you guys for listening to us ramble for an hour with Josh's lights on. Once again this evening.
They should have turned off by now.
But we appreciate you guys. We're grateful for you being here. And yeah, I think we'll be back next week, Josh. We're going to show up again. Do this again.
We're going to be here. We're going to be here. Have we looked at the Christmas season? Where does Christmas live fall?
I think it falls.
It is on Christmas. We will not be here on Christmas. We will be here on because it's Christmas Day. Are we going to sit there in our reindeer suits, our Santa suits with our beards
I think
on?
we should do it a morning episode. As the kids are unwrapping presents. That. Yeah. Anyhow, thank you guys for being here. We'll see you next week. Till then.